What's up, investors? So you're not going to believe it, but actually found a way how to do 49.4 annualized return, non-compound, with options, collateral, and ETF usage. So it's hard to believe, but I'm going to actually put this trade on myself to test to see how it works out. I'm going to check back in a few months to see how it did. But this is basically it. Oh, that's not it. Yeah, it's nothing. So this is how you do it. Step one is we're going to buy 1 to 3 month treasury ETF. There's SGov, or I'm going to use BOXX, which is basically a box trade exchange traded fund. It's a complicated way of getting about a 5 to 6% yield at the current environment using complex option strategies. And we're going to overlay that complex option strategy with a complex option strategy of our own. Okay, so try to stay with me here. So first, we're going to use the cash that we have. In this case, we're going to use about 30K of it. And I'm going to buy BOXX. And I'm going to use that to take out margin. And I'm going to use that margin to operate. Okay, so I'm going to use the ETF as collateral. And then I'm going to find a company. Step number 3 is I'm going to find a company, and I have one in mind, I'll show you, that is consisting mostly of cash. I want the cash on the company to be about equal to its market cap. Market cap is market capitalization, which is basically the price of the company itself. So I want the company to be basically flushed with cash to the T, to where the value of its cash is equal or greater than the company itself. All right. Also, we have to make sure that money, the company is not losing money like precipitously. It has to at least maintain that cash position for at least a certain amount of time. And there is a few checks that make sure that that's going to happen. Okay, I'll show you in a minute. And number 4, we're going to use margin as collateral to basically sell put options. So instead of using the cash itself, we're going to use the margin to sell put options. And if those put options end up getting exercised a few months down the road or a year down the road, then I have the cash on hand to convert by selling the ETF, and I'll basically not be liable to pay yield on the margin. Okay, so that's basically the agenda. That's how you do it. I'm going to go step by step here. So the first thing, like I said, is we're going to buy BOXX. That's pretty self-explanatory, or SGov, or any kind of 1 to 3 month treasury ETF. So we get the benefit of getting that, similar to market money making yield return on our cash. Okay, so once we have that, the next step is you're going to make sure that you have a margin account. Okay, you need the margin account in order to squeeze that extra 5 point something percent out of this trade. Okay, the step number 3 is what we're going to do now, which is find a company that has a market value, market cap, that is equal, okay, or less than its cash position. Currently, believe it or not, the very app that we're using, okay, to demonstrate this trade, Robinhood Markets, is the company that holds more cash on its balance sheet than it's worth to the markets and market cap. It's kind of incredible, but that actually does exist. Over here, you'll see that an enterprise value is negative 681 million. So basically, if you buy Robinhood, you're getting it not just for free, but at a premium, which is quite amazing. All right. Now, there are plenty of reasons that exists. Sometimes the companies bleed a lot of cash, so the presumption is that the cash will be bled in time, and the company will end up be, worth less than it is right now, by a significant margin. So we'll see if that actually transpires or not. There's a few ways that we can check if that looks like to be the case. So we need to do some fundamental research. Okay, so the way I start the fundamental research is by going in the financials first. We're going to use, instead of yearly, we're going to use quarterly, so we can get more definition into the numbers. Now, if you're curious, the website that I'm using here is actually stockanalysis.com. So it's a free website. I like it. I'm not affiliated with anyone, especially, you know, some websites, but I do like the website to do some research on. So if you're interested in doing some research of your own, that's a place that I like to go to. Okay. So in order to figure this out, let's say the company is going to run into trouble. First, I'm going to take a look at its revenue trend, and it looks like as interest rates have been rising, the revenue of the company's actually been increasing. So Robinhood is a growth company. They're trying to acquire many accounts, and they have all kinds of promotions that's costing them a tons of money. And so they're paying a lot for the revenue at the moment, but eventually the growth period, the cash burning period of the company is going to decrease. And I believe that the company is going to start actually be consistently profitable. But that's for a topic for another day. Let's see how the profits actually doing so far. Are they going to be in trouble? And it looks like since 2021 they've spent a ton of money for, you know, staff, for promotions, etc. But since then their losses per quarter has actually stabilized, and in fact they turned a profit for the first time since 2021 this past quarter of about $20 million. So they are getting a lot of interest earnings from, you know, the trade that they're doing. Basically they're taking the deposits from the cash deposits from customers and flipping them for a slightly higher interest rate, which is what all banks do with cash deposits when the money on the money market account side. And so they're getting some interest off that, as well as they're getting interest on the cash on their balance sheet. And of course, you know, they have other forms of revenue like Robinhood Gold, which I pay $5 a month. So all the Robinhood Gold customers, they pay that. As well as there are outsourcing market operations. So they're getting some money off of that as well. So they have a diversified, you know, way of getting money. So I think that they're going to be pretty safe. I don't know if they're going to be have taken a huge hit to their earnings anytime soon, which means the company is going to be fairly stable, and they don't really need all that much cash to operate. In order to make sure that shares outstanding is pretty stable, we're going to click this, and we'll see that at least since the beginning of 2022, the share count's been fairly stable. It's been increasing by a little bit, so you want to look at this to make sure that the company is not diluting you into less ownership of the company over time. And outside of the 2021 period, when they tried to expand a little too quick, everything has kind of stabilized since then. So I think we're not in danger to hold this over the course of a year, let's say, and have our trade be blown up. So once I make sure that this company is good enough, all right, in order to park my money there in case I have to buy the shares, then we can proceed to the next step. And the next step is use the margin as collateral to sell put options. So I'm going to show you how to do that. All right, and then I'll show you the math behind all of it. Okay, so what we want to do is we want to go in any brokerage. It doesn't have to be obviously Robinhood. I mean, I like it because it's very simple to use. I have other brokerages that I use, including, you know, interactive brokers, which I use pretty often actually. I have more accounts than this one. So you can use. I also have an E-Trade account that's kind of dead. I also use Wealthfront for my IRAs, etc. But, you know, again, I'm not affiliated with anyone, so I'm just telling you what I like and what I use. Many people swear by TD Ameritrade, but it really doesn't matter what your broker is as long as you can do options and you can take out margin. So those are the two requirements. It doesn't really even matter what you pay on your margin. It can be high or a low percent because we're never going to pay that percent. Never going to pay it. All right, moving on. So how do we set this up? At least in this broker, the button for options is on the right here. You'll find it in a similar positioning on the app as well. And what you want to do is sell a put option that's a little bit below the price. So you're going to do that after you pick a date. Let's pick a date that's 29 days away, so about a month away. So it's easy to do the math. And what we're going to do is click sell and then put. We're going to go to the 10.5 strike price. And we're going to sell a few contracts. Namely, we're going to sell 30 of them because of the 10.5 strike price. We can afford a lot more contracts. And you'll see the total number of dollars here is a little bit over 30K, but we're going to round it down to 30K. If you want to use our slightly smaller figures and do your own math, you're welcome to. I'm just doing approximate figures because by the time we execute these contracts, the price is not going to be the same anyways. So we want kind of a ballpark understanding of what the numbers mean. So it says over here, the maximum profit, if you can see that, you're probably able to see it on the desktop. I don't know if you're watching on the phone, maybe you need to zoom in a little bit. But it says $1,110 max profit, okay, for a month. And then a max loss, don't worry about that. That means if the shares get bought and then the shares go to zero, which is not going to happen, right? With $10 billion in the bank and 10 billion market cap, it's just not going to happen. So you're probably not even going to have to purchase the shares. I'll tell you what happens if you do have to purchase them. So for now, we're selling. By the way, none of this is financial advice. This is just stuff that I'm doing and sharing with you so you can perhaps learn or experiment. But if you're confused about any of this, please consult with a professional financial advisor, and you can try the stuff on your own if you want, but make sure to do it with a very small sum because the risk is very high that you could have total loss of capital in the market. So make sure that you know that and don't play around with your life savings, all right? So moving on, I'm going to sell 10.5 put options. So like I said, the profit is $1,110, so we're going to write that down. And then we're going to get a at least a 5% yield off of, let's say, SGov. Let's see what it's paying right now. SGov is an ETF that is paying a dividend similar to the 1 to 3 months treasury yield at the moment, which turns out to be about, where's the percentage here? I'm blind. Okay, 5.29% is the 30-day yield with expense ratio of 0.13. We can subtract that. So we get about a 5.16%, which is higher than just parking your cash at Robinhood at 4.9% yield, which is one of the highest yields for a money market account, by the way, and all the brokers, especially because of the gold tier. But you can get similar yields in other brokers. Usually they're a little bit worse than 4.9%. Either way, we're getting a yield that's higher than 5%. So you can adjust the numbers if you want to do exact math. We're factoring that 5% in, and then we're also factoring the $1,110 we're going to get from the put options as premium. So we're looking at math, okay? So here we go. The yield for $30,000 on a monthly ETF like BOXX, which is the complex strategy ETF that I mentioned, is about $125. Now Box pays a little bit higher than 5%. So again, this is like a rough figure. So this is probably $130 or $135 or higher. And same thing for SGov, it's probably $130 or higher, but we're just rounding down to be safe, okay? And then we got the $1,110 from the 30 put option contracts. We add those together, we get $1,235 per month on a $30,000 investment, okay, which is about a 4.17 return per month, or a 49.4% in a non-compound manner per year. Non-compound means that you just keep repeating the same process. Compounding means that you use the extra profits in order to buy an extra contract or 3 each month, and that way you maximize your returns. But we're not going to do that for right now. You can do the math yourself if you want to extrapolate the compound interest, but we're just going to do non-compound per year. Another reason I want to use non-compound is because you may want to do this just once for the entire year. Just pull out a leap, right? Just make sure you sell a put option that's dated 1 year out. The premium is going to be a lot higher, and actually the risk of buying the stock at a lower price is not going to be as high because of the extra premium you're going to be getting. The further out you go, there's a little bit less risk. The downside, of course, the further out you go is that your money is going to be tied up for the entire duration, which is the same with any investment. I mean, in fact, if you buy CDs or invest in treasuries or whatever, your money is going to be tied up no matter what for those long duration trades. So locking your money up for a long period of time sometimes not necessarily a bad thing. And for a close to a 50% return, now that is something that I approve of. Okay. Again, not financial advice. All right. I'm just an investor just like you, and I just share my thoughts on YouTube. Okay. I'm not a financial advisor. I'm especially not your financial advisor. This is just what I'm doing. It's worth repeating. Okay. So we did the math and we did the process. If you want to take a screenshot of this or something, save it. If you want to try with a small amount of money, by small amount of money, I say like 1 or 2% of your net worth at the maximum, or even 5% if you want to be super risky, but I wouldn't try anything new with 5% of your net worth. So make sure you do it a very small percentage, and see what happens. I'm going to do this trade myself. I'm probably going to make another video to update everyone on how it went. I have some options expiring at the end of this week, so I'll probably put it in motion next Monday. Now, you have a chance to front run me. I don't think I'll be able to place it tomorrow, but you can do the same thing if you want. I'm going to do it. If you're interested in what the results are, you can check back in a few months or longer. I'll probably make videos in interim trying to update everyone on what's going on. And also I do company reviews, and I talk about the markets, talk about lessons that I've learned through my financial investing process here, investing adventure. And that's what I plan on doing. So hopefully this works out. I'm gonna report back and see what happens. Good luck to all of you, and peace out.